Good afternoon. Welcome to YXI Insights. Today is June 20th after the market open. So another market update just after the FOMC. We're going to cover our latest framework called the 4321. I'm very excited to share with you. We're going to talk about SPY, the valuation levels, and we're going to talk about the Fed, Wednesday's meeting, and we are going to look at live chart updates for SPY, QQQ, bonds, oil, Bitcoin, Max 7s, gold, stocks, everything. All right, let's begin. So this week we have established the 4321 method. You will not be forgiven if you forget the name of this method. I created it out of the sheer simplicity that it entails. But behind this simplicity, there's a lot of work and thinking going into this method. So the 4321 refers to the weighting we assign to the four different methods we use in analyzing any risk assets in our universe. By risk assets, I mean equities and crypto primarily. 4 points are awarded if our quantitative signal each day shows a risk-on signal for the asset. So for example, SPY has a risk-on signal today. It gets 4 points. But if it has a risk-off signal, it gets 0 points. So that's where the 4 goes in this method. Then we give a maximum of 3 points to the technical analysis. So the technical analysis has 3 aspects to this: the long-term trend, the short-term trend, and whether it's approaching some sort of resistance level that we expect. So for example, SPY has recovered from the April 7th bottom. I don't see a lower low from here. And I think in the medium term, it would make a new all-time high and move up from there, right? So the medium term, it gets 1 point. Short term has pretty bullish momentum since April. So you can't really say that SPY has not performed well in the past 2 months. It has performed very well. So it gets another point. But now it's approaching a key resistance level at the 1.38 extension of wave 1. So again, here it's prone to pullback. I'm waiting. So therefore, I'm giving it 0. So that's 2 out of 3 points for the technical analysis. Then 2 points on valuation for SPY. We're comparing SPY's attractiveness versus bonds because that's the alternative, risk-free alternative for investors. SPY trades at a forward valuation at 22x versus bond yield, the 10-year bond yield at 4.5%, pretty much similar. And that makes it actually unattractive versus owning bonds, which is risk-free, right? I don't expect the US government to default in the next 10 years. If it does, SPY will do much worse. So from that perspective, I will give 0 point to the peer comparison. If it's a Max 7 stock, I'm looking at Apple's valuation versus growth compared to other Max 7 peers. So in that case, Apple would also receive a 0 because Amazon, Meta, and NVDA are trading at better growth adjusted valuation levels than Apple because Apple is not growing. And then the second point goes to historical valuation. So for historical, we're looking at SPY's valuation versus historical levels in the past 10 years. SPY is trading near 2 standard deviations. That makes it quite unattractive in terms of valuation perspective. The long-term investors must realize that everything you're buying today is for a discounted free cash flow from the future. So buying at an expensive level here automatically makes the future returns more likely to be lower than if you were buying near the mean or below the mean. And finally, the final point goes to seasonality. We're looking at just the 10 days forward, because if we look at 30 days, it might not be that useful that we're looking at this thing every day and every week. So I think 10 days is a happy minimum, let's say. SPY seasonally is weaker in the next 10 days, as June generally is a weak month. Therefore, it doesn't get the seasonality point. Whereas if we're looking at the beginning of July, if today is July 1st and looking for 10 days forward, it's a bullish period, historically speaking. Therefore, it would get that extra point for seasonality. But putting all of this together, 4 points for quantitative, 3 points for technical, 2 points for valuation, 1 point for seasonality. We give assess out of 10 points, SPY gets 6 points. It's not a bad rating because it's at least above 5, because the quantitative signal is saying risk on still. But let's say if the technical side, our human judgment of the technical chart says 0, 0 for the long-term trends and short-term trends, and is just not appealing in terms of valuation either, then it would be a 4 only, despite what the machine thinks. And therefore, that would make it maybe on the unattractive side of owning the stock. And it's obviously up to everyone how you want to use this, whether you want to put, for example, 10 means 100% positioning, 6 means 60%, and 4 means 40%, or it could be more binary, where if this score is above 5, one could consider owning some. If it's below 5, one could just stay out of it. It's up to the individual how they want to use the metric, and we're not giving financial advice here. So now, looking at a key chart that I have found, that we actually covered this before. So the fact that it's still holding this week is a very positive signal that we are finding something that's concrete. So inverse dollar levels versus SPY. What we found is that dollar strength is in an inverse relationship with equity indices with a 60-day lead. So when DXY goes higher, so this is the inverse, going lower, SPY tends to move lower 60 days later. And this is very important. Why 60 days? It's not a coincidence. We've seen a similar relationship for Bitcoin and stocks like Tesla, where the global M2 money supply levels lead by 60 days on the asset. And for those global liquidity, dollar is an important component because global liquidity is denominated in dollar. A stronger dollar makes the overall collaterals like bonds, high-grade credit, FX swaps, the value of those instruments as collateral lower. So stronger dollar makes liquidity poorer. And as liquidity shrinks, it has a knock-on impact over the next 60-day period and works into the financial markets. So it's not an immediate impact, but it has approximately a 3-month lead. This lead could shrink over time. I suspect it will, because when people start realizing there's an edge in certain patterns, they start crowding into the trade and front run it, and therefore the impact diminishes over time. But for now, this 60-day lead still holds. And what we see now is that past week and going to mid next week, we are actually seeing dollar getting stronger 60 days ago, and therefore lower on the inverse scale, which could weigh on SPY. That's what you see the coin SPY building a local top around the same time as the dollar weakness built up. And now as dollar strengthens, SPY moves lower. So I expect SPY to be facing a bit more headwind into midweek next week, but it could be ripping much higher in July if this relationship holds. And then now we're looking at the FOMC on Wednesday. What happened is that the Fed is essentially in a very, very firm wait-and-see mode. The Fed basically worries about stagflation, the potential for economic weaknesses, high unemployment, with inflation still staying above target. Therefore, while they kept the 2 cuts for 2025, which I suspect will come in September and December separately, the Fed leans towards having just 1 cut in 2026 and 1 cut in 2027. So these are at the levels above what the market expected. But I think we can't really take this dot plot very literally, because Powell acknowledges that the Fed simply doesn't know what sort of outcome we're going to see from the tariff policy impact. There could be a variety of outcomes. Inflation could be transitory, because the price hikes have one-off impact. Inflation could be persistent if tariffs are staggered and the policies increase the levels over time. Or there could be no inflation because of the demand side destruction, and we're seeing weaker growth, therefore deflation. The Fed simply does not want to preempt which way it goes, and they want to observe more data. So the July meeting is also off the table because Powell clearly said they need the next couple of months will be a great opportunity to further observe the market. So they don't want to rush into anything. September is the earliest likely meeting for the first cut, and I would say December, which is another meeting that is most likely because usually because in September's and December's the Fed releases new dot plots, etc., and it can better explain their thinking. So looking at the FOMC dates, the market projects between 3 and 4 cuts in the next 12 months. This hasn't really changed that much. Therefore, this hasn't really changed that much. It's been around those levels for the past 2 months. So it's been quite a boring table to monitor for now. I think that we really need a very weak non-farm payrolls report or a very weak CPI report to move the needle for more cuts from here. Now, let's look at our systematic signals. Is one across the table for all of the assets, including TLT and Bitcoin, for this week. And we have made an upgrade to our model this week, where the strategy is to buy or sell at the open if there's a switch in the signal. And they've been backtested to show very robust returns and Sharpe ratios. And I've compiled returns for both this week, since our signals launch, for the V2 version, and versus the V1, the return since the V1 launch, which is in April and May. And I'm going to drop those calculations next week onwards. So this is just for guidance for now, as we just launched the V2, so it's got a better comparison. But next week onwards, we're just going to use the V2 launch dates and their returns, strategy returns, and the buy and sell at the open model. Looking at SPY, SPY has moved just shy of the 1.382 extension of this wave 1. And it's been moving sideways for the past 2 weeks, despite the rising tensions in the Middle East. So the market is shrugging off what's happening in the Middle East. And I don't necessarily think that the market thinks that the Middle East conflict will resolve itself quickly, etc. I think the bigger factor is sentiment and liquidity towards risk assets generally at this moment. We're seeing a pretty quick recovery from April 17th. And overall, this looks like a V-shaped recovery already. So there has been a lot of momentum in the risk assets. And we are seeing frenzy in certain corners of the market. For example, the latest IPO of Circle is moving up 20% every single day, is up something like 400% since IPO. That even spilled over into Coinbase market. So typically Coinbase, for example, trades with Bitcoin, but this time, because Coinbase is associated with Circle, is also moving up a lot. So we're seeing, and we're also seeing names like Oscar getting the retail push because everyone's looking for the next HIMS. So we're seeing some frantic actions in certain corners of the market. That is a sign of a bull market rather than bear market. So I don't think this is a bear market rally. And what I would expect is a wave 4 pullback next, but potentially quite shallow, and only just testing if maybe just above the 200-day moving average. And I think if that pullback occurs, it could be a great dip buying opportunity. So a shallow pullback and a new all-time high and much higher is my current expectation. QQQ, similarly, I think we could get a shallower pullback than wave 4, but I have put it in this level between the 0.38 and the 0.23 retrace of this wave 3, just above a 200-day moving average as the first guide for this wave 4 pullback. It's currently moving along this resistance line, which we've spotted from a while back. So it's working according to our expectation. And if it dips over here, I do think it's a corrective pullback that is very viable. We see USO at the 200% extension of this wave 1. This is an extended run that could see a pullback in the wave 4 here that could end around the mid-70s. But ultimately, I do think there's a final wave 5 high after the next pullback. So oil, if you zoom out a little bit, oil has been trading in this wide range between 60 and 80 since 2023. I think we could break above this trading range in the wave 5, immediate wave 5 high. But how that chart resolves towards in the broader picture is a little bit messy at the moment. Looking at yields, for me, I still think we are in an upward trend since 2024. And we are still at the highs of April and January. So there hasn't been that much fundamental change in the past couple of weeks. There's still this large budget that's trying to get passed in the Senate, and that should increase the fiscal spending and therefore the supply risk for the long-term bonds. But in the short term, we could potentially retest this 200 EMA. I would say the short-term picture is not that clear, but the long-term, the medium-term trajectory is still in the upward range. This may differ from other people's analysis, but this is my current view, which is bearish on bonds and yields moving high in the medium term. So in correspondence, high yields means lower bond prices. I think TLT could test this 200-day EMA moving average in the near term. I don't have a strong opinion on this short-term move, but over the medium term, I do think TLT, especially after making this new low here, is in a bearish trajectory from here. Bitcoin is in a consolidation and continuation pattern. So this is not in the Elliott wave terms. In the traditional analysis, this is a symmetrical triangle. We're having lower highs and higher lows. Prices are converging towards this point, but the RSI is being supported by this lower trend line here. So I do expect the chart to resolve upwards potentially next week for Bitcoin. So right now, I actually do think this is a buyable dip, and the wave 4 low is still holding pretty well. The next one up is wave 5 for with a target of 115 to 120. And looking at the global M2 levels relative to Bitcoin, this corresponds to our dollar conversation earlier as well. We were in this corrective pattern here for the global M2 with a 3-month lead. That essentially put a bit of pressure on Bitcoin's price near term. But going into next week, we could see the M2 supply resolving much higher, leading to a higher Bitcoin price with a 3-month lead. So for me, here is not the top. And I think this is a continuation pattern that is just digesting some of the moves. We're still seeing healthy inflows in the spot Bitcoin ETFs. To me, I do think Bitcoin should make a new all-time high soon, potentially in July. For gold, I have put in this red path because I think initially I did think this could be a wave B, but considering where the global liquidity is going and actually also the fundamental side of things where China is still buying accumulating gold at a quite quick rate off the books. Uh, and given this price action of essentially matching the all-time high here, I think there's a very strong argument for gold moving higher and GLD into the 350 region here. So this could be a shallow wave 1, 2, and we're moving towards wave 3 that has a target around 325 to 340. And that would put this, what I did think as a blow off top, potentially just a wave 3 top. And this could be the real wave 3, the wave 5. So this is not a high confidence read. And I identified this trend line here that has been the resistance, which GLD has broken above and now retesting as support. I think if this holds as we move towards this wave 3 target, this red path will become my primary expectation, and I can shift the larger degree labels accordingly. So I do think this red path, bullish path, has become much more likely in the past week. Now moving on to Apple. Apple is not an easy chart to decipher. So today I actually zoomed out and just taking a look at things and just looking at what Apple did before up to this point. And what we see is that between 2002 until today, Apple has been more or less in a consolidation pattern. It moved lower, backed off from this resistance level into the 120 area, break above, retested, and then break above higher, and now retesting this support region. My worry is that with the rest of the market essentially rallying, Apple moving nowhere, with still quite expensive valuation attached, we could be in for first a near-term deeper retrace on the smaller degree retrace, because if you look at this as a continuation pattern, this could be a bear flag, and we see a further move down. And actually, this wave 3, this was a wave end of the wave 3 versus a potential wave 4 correction down here in this channel. So if this region seems to be a gravitational area where the price oscillates around in the past 4 years. And if you think about the fundamentals, Apple hasn't really grown in the past 4 years either. It's selling similar number of iPhones. It's retreating from the China market. It hasn't made any significant upgrades in terms of hardware, except for the Apple Vision Pro, but people are not really using it that much either. So this price range is actually quite self-explanatory for where the Apple's fundamentals have been as well. My primary concern is that this magnet could get Apple back again, and it could fall through to, if this is wave A and we get a wave B bounce, whether it's here or even higher at the 200-day EMA, we can still get a wave C lower, and that could complete the wave 4 first. And at the bottom wave 4, magically we have a new product around the corner that everyone starts to get excited again, or maybe the Vision Pro has some sort of cheaper price tag, better improvements, and getting more sticky with more use cases, etc. It's always the price driving narrative. But for now, I think the overall trend is to the downside, and I've removed my bullish expectations just for the moment. I will get into the near-term price action a bit better on Monday. Amazon, when Amazon hit this 220 mark, on Wednesday, June 11th, I said this has sufficiency for wave 5 completing. And we retested this level a couple of times in the past week, and then now it's turning down. So for me, of course, there is room higher to get above 220 in this wave 5 to fill out the pattern a bit more. But for me, the risk reward is not really great in chasing for this target above. And there's growing risk that we've completed the 5-wave pattern and we're resetting for a 1-2 setup on the smaller degree here. Google is very similar. It touched the 123 extension of this wave 4 to complete wave 5 at a minimum. And by the look of it, I do think this wave 5 is probably complete now, and we could be seeing a setup to the lower for the wave for 1-2 setup. And what we see on the index level is SPY having a wave 4 pullback led by the MAC 7 weakness. And if this is a wave 2, a larger degree wave 2 pullback, so that makes the 1-2 setup, we can expect a pullback down to 154 to 160 as the first target here. But of course, it might not get there in one go. It could be a ABC corrective pullback. But this is beginning to become my primary expectation now for a wave 2 pullback on the larger degree here. Meta hit the resistance at the 200% extension of this wave 4. And we can now expect, my expectation is 5 waves are completed with the extended wave 5 run. And we could see a pullback to at least test this 200-day moving average and this heavily traded volume profile here. Microsoft just makes a new high every single day. It also made a new high today, intraday. I'm just waiting for the wave 4 because I think since here we've been waiting for the wave 4, it's moved up a few percentage points, but the risk reward is just not really there. I do think we should test this 200-day moving average in wave 4. And if you look at how long it stayed in this overbought region with this momentum stalling, my concern is that when it snaps back, as the bullish side gets exhausted here, it could move down quite quickly in this pullback. So I'm definitely not chasing. I'll be a patient observer for Microsoft in the meantime. NVDA, I do think it's reached all 5 waves of this wave 3. And I'm again expecting wave 4 pullback here. And wave 3 here has reached a minimum expectation of 1.38 to extension of this wave 1. So where could wave 4 end? Wave 4 could really be anywhere between 0.5 and 0.236 retrace of this wave 3. The fact that this wave 2 was quite steep could mean that the pullback will also be quite shallow because of the alternating theory. With a steep wave 2, wave 4 tends to be shallow and vice versa. And that could still land us on the 200-day moving average. So again, I'm not chasing it here. I'm just patiently observing. Tesla is actually not extremely clear on which way it could go next. My primary expectation is that we are in a wave C with a 1-2 setup to the downside. And this wave 2 completed at the 0.61 retrace of this wave 1. Very standard stuff. There is an off chance that we are in a bullish alternative path where there's a wave 1, 2, and wave 3 and 4 pullback with the Elon Trust drama with Donald Trump, and we still have wave 5. So if we and we have the robotaxi rolling out soon. So to me, the risk on either side, both parties, is quite balanced. If I were to try the bullish setup, I would have a stop loss here for sure. Because once we get below this wave 4 alternative low, it's very unlikely this wave 5 will still happen. And it's more likely that we're actually in the downward wave 3. So if I were to enter around the 200-day moving average, I would target the 400 area, and I would have a stop just below 270. And finally, SOXX, the semiconductor ETF, very similar to NVIDIA. We've completed all 5 waves here, or we have sufficiency to complete all 5 waves. Obviously, they could move higher in a more extended wave, wave 3, but I would expect a wave 4 next. And again, it's very similar to NVIDIA. This steep wave 2 pullback could result in a shallow wave 4 pullback here, just to test the 200-day moving average. And that would land us around the 0.38 to the 0.23 retrace of this wave 3. So thank you very much. Any questions, let me know in the comments or on Slack or on X, and we'll talk. We'll come back next week.